Money Show.
Personal Finance with Warren Ingram.
24 minutes to 8 o'clock. Now, talking personal finance, talking about how to reorganize your budgets to get the best out of your budget, because it's 2022 and the petrol price has gone up. All sorts of things have happened. Interest rates will be going up some more. We spoke about that earlier on this week. So, talking about getting your financial plan ready for this year. And Warren Ingram from Galileo Capital joins us. Good evening, Warren.
Good evening, Ray. Great to be on the show with you.
Good to chat to you once again as well. Now, what is the first step in revisiting your budget then?
I think, Ray, it's always the kind of cornerstone of any big financial plan is controlling the money that comes into your account and then more especially the money that goes out of your account. So, controlling the incoming and the outgoing is for me, the reason why people get to financial freedom. Or the reason why they don't make it. So I think when we're coming out of a nice big holiday season, that has to be the starting point. Understand what are you spending in a typical month, and what have you spent in the last month, because for most of us we tend to overspend a little bit on the holidays, which is great, but now we need to get kind of back into our financial fitness routine. And that starts with understanding how we spend. And then also, if we look at what we're earning, understand if what you're spending is a bit more than what you're earning, you're going to need to make some tough decisions in the months ahead. And the only way you can make those decisions is to understand your reality, understand where you are now, actually what is going on in your bank account, and then, take some action. And I always think, people look at this and they go, oh, no, that's impossible. It's so horrible to kind of make these trade-off decisions. I don't want to do it. The problem is, you keep ignoring it and you keep avoiding it. The problems are going to get bigger for you over time. And I think, the way you tackle any big problem, we all know, is you take little bites at it and eventually you deal with it. So, if you are overspending now, and let's say you're overspending by 5,000 Rand a month, there's no chance that you're going to make a change from 1 month to the next, where you sort that whole problem out in 1 month. My view is, then start small by saying, well, next month I need to reduce my expenses by 4,500. In other words, cut your expenses by 500 Rand a month, so that the following month you're overspending by 4,500. The month after that, drop another 500 bucks, and so on and so on. So that by the time you get to, let's say, the middle of the year, you're spending correctly, and then the month thereafter you're starting to save, and I think that that's the way you can do this. It must be a realistic exercise, Ray. A lot of people make these big New Year's resolutions that are totally unrealistic. They promise they're going to run up Kilimanjaro, and of course, if you haven't run 5 kilometers in your life before, how on earth are you going to run up Kilimanjaro? And to me, the starting point is be realistic, be predictable, and then be consistent.
Interesting you say that. Do we also not perhaps need to cut the fat? Very often we're very careless with our debit orders. We may not need that gym contract or that gym exercise. We may not need something else. If you cut it off, you trim the fat, you may just be saving $2,000 a month.
Absolutely. And I think you're right. Debit orders and nowadays, subscriptions, whether it be for streaming channels, online magazines, all of that stuff. We need to look at those and just do an overall review beginning to end. If you're still paying for a gym contract and you haven't been to gym for the last 650 days, what on earth are you doing that for? Why are you doing that? And I think, one of the interesting things about the whole pandemic was it did help us understand actually what was important in life. What were the things that we got enjoyment out of when we were spending, and what were the things that were just absolutely useless. And I tend to think about, those first few months of the hard lockdown, all the people that were overspending on cars, that were spending 10 or 20,000 Rand a month on a car that was just simply sitting in their carport or in their garage, doing nothing, going nowhere, impressing nobody. Why on earth were they spending that money? And I think hopefully a lot of people have had a good reality check to say, actually what's important was, experiences and spending time with family, and eventually, actually being able to travel a little bit, not to impress people, but just to kind of get enjoyment from life again. And I think, that's the kind of stuff that we need to do, is we need to reset and rebase ourselves. yes, the pandemic was awful, and there is no way that you can say it created more positives than negatives. It didn't. But one small positive was, I think it helped a lot of people to understand what was important in life again.
Yeah, it did, didn't it? Because in many respects, we stayed home. We weren't eating those lovely takeaways that we like to eat all the time because we couldn't order them. For a while, all those food places were closed down. We did learn a lot, didn't we?
Absolutely. I think about myself, the thing that became the absolute luxury was trying to find, in the middle of winter in lockdown, was trying to find warm, comfortable footwear.
Yeah, I remember.
Finding slippers was kind of a luxury that I appreciated. And yes, my wife joined the air fryer club, and so we kind of we became the cliche. But what's interesting is that stayed with us. We're not overspending on clothes, and we're not going out to flash restaurants. We certainly are trying to support our local restaurants again, and even if that means getting takeaways from them every now and then, but it's not sort of mindlessly, every day driving to work, grabbing a coffee on the way back again, picking up something, just because we failed to plan for our meals and our getting our lives in order again. And and that's another one, Ray. If you want to kind of cut out spending unnecessary money on food, just do a little bit of planning. Spend a bit of time when you're at home, cooking bulk meals, putting them, into kind of portions of one or two and chucking them in the freezer. And, when you feel like a takeaway, go get a takeaway from your freezer. And that for me saves a huge amount of money.
What do you do with an emergency fund? And a lot of people see an emergency fund as a luxury, but it isn't, is it? Because if you get yourself into trouble and you need it, and you don't have it, then you land up going to borrow and you pay interest. It's very important, isn't it?
Absolutely. For many years, I've struggled to think of a really good example for people to say, what's an unforeseen emergency that will just derail your whole life in a matter of days or weeks. And unfortunately, the pandemic has given us a great example that, that's real for all of us. Something big can happen that just stops your whole financial life in its tracks. And then, the question is, what do you do to protect yourself from something that you really cannot predict, that you cannot foresee? And to me, that's an emergency fund. And it doesn't need to be a complicated thing. It's, put a savings account together that's linked to your banking profile, a money market account or a money market unit trust. The amount that you should have in there, I think, is around 3 to 6 months worth of your expenses. And it should be something that you can access very quickly. And the function it has in your life is to help you when the unforeseen financial emergency arises and prevents you from having to go into debt or having to sell a high quality investment, at the wrong time. And just think about the pandemic again. When COVID hit, it caused the stock market crash. And for a lot of people, if they didn't have an emergency fund and they were retrenched or went on furlough, they immediately had to go and sell investments, and they were selling investments at a 30 or 40% discount to their real value. And that's just tragic, So I think, once you've got your expenses sorted out, the next thing is make sure your emergency fund is in place. If it's not, make sure you start building it up. Don't do anything else until it's done. Don't worry about investing and anything, because the emergency fund is your biggest form of self-insurance, and you have to protect yourself against whatever else may happen in the next months and years ahead.
I suppose if you're clever though, Warren, you can use your emergency fund as an investment in a way, as long as you can get that money out immediately. It can't be a 32-day notice account, because if you do it that way, well, that's not going to work.
I agree with that, but I'm scared that people start to kind of overlap the two, Ray, where they think of an emergency fund and an investment as one thing, because an investment you're hoping is a 5 or 10 year long-term capital growth engine, whereas your emergency fund is going to deliver you the most boring, pedestrian, mundane little bit of interest every month. It's really not a growth thing at all, but it's just a really cheap form of self-insurance. The interest that you earn should be viewed as a bonus. For people who are really financially disciplined, one thing you can look at is overpaying money into your home loan, for example. So, if you owe the bank, R1 million on your home, but you've actually paid in, an extra 100 or 200,000, then that extra money you could view as an emergency fund. But I wouldn't necessarily view my investments as part of my emergency fund.
Right. Okay. Sound advice. Now, you're very lucky. You got Mrs. Ingram at home. Do you need to have a money buddy to help you do this together? It's like gymming, you see. So Warren and Ray go off to gym, and then Ray doesn't feel like it because it's cold, and then Warren goes and gets him out of bed. Is the same sort of thing applicable to money?
Absolutely. I think, the fitness and financial health, I think, are massively related in the point that it's all about habits. It's all about the way we spend. And fitness is exactly the same. It's about forming good habits and avoiding the bad habits. And so if you need to know yourself. If you're not financially disciplined and you've got bad money habits, then all the things we talk about are kind of pointless if you're not going to stick to your goals and stick to your objectives. And so I would say, in South Africa, we've got this brilliant thing, which is a stokvel. And I think the psychology of a stokvel is brilliant. It's really saying, let's use positive peer pressure to help us develop good habits. Now I'm not saying you need to start a stokvel just for yourself, and get a group of your friends to all kind of hold you to account every month. You don't need to explain everything in your financial life with them, but you can either use a stokvel kind of dynamic to say, well, let's start, an investment club. We're not putting our money together, but we're setting goals together where we're going to say, I promise I'm going to start saving, 10% of my salary every month. And, next month I have to go and sit in my little group and tell my investment club, what I did. And if I haven't met my goals, that's embarrassing for me. So guess what? I'm going to start doing it.
Yeah.
If you don't want to share that information with a group of people, then yes, get one money buddy. Get someone that you trust that can hold you to account. And make sure that you're doing what you're supposed to do, and you help them do the same thing. And it's amazing that positive peer pressure really does help us form those good habits. I mean, for me, when I started running, getting up in Johannesburg in the middle of winter was really awful. But knowing I've got someone waiting for me outside, and it's -3, I can't keep them waiting. I got up and I did my deal. And I think the same with money, find someone that's going to hold you to account.
So that's where Bruce disappears all the time. I always wondered where he was early in the morning. We can never get hold of him. Okay. Yeah, right. Anyway, back to reality now. Now, developing a plan for your debt, that's also very important for 2022.
Absolutely. If we talk about financial issues, and when you do the Q&As and you ask people to send their questions on air, inevitably it's going to be about questions around debt. I think debt is kind of a weapon of wealth destruction in South Africa, and the financial institutions make it really easy for us to get debt. So that means that the bulk of salary earners in South Africa are sitting with too much debt. And so, no financial planning conversation can take place, and not talk about debt. So when we're talking about it, what are we talking about? I think we're talking about eliminating bad debt. And bad debt in my mind is, things like credit cards, store cards, personal loans, overdrafts, microloans. Anything where you've incurred debt to buy stuff that doesn't actually have value. So if you borrowing money to go on holiday, or borrowing money to buy fancy clothes that you can impress people on your Zoom calls, those are the things that I consider to be really bad debt. So getting rid of bad debt is critical, to your plan. So once you've got your emergency fund sorted out, the next thing is make sure that you get rid of your bad debt. And generally, bad debt is the stuff that's most expensive. And I'm not talking about the thing that costs you the most rands per month, but I'm talking about the things that cost you the highest rate of interest. So if something costs you, let's say a credit card costs you 20 or 25% interest a year, that's your most expensive debt. That's the stuff you must get rid of first. And then you can kind of knock that off and then go to your neutral debt, which would probably be your car, and make sure you pay it off a bit quicker than needed. And then lastly, your home loan. And your home loan, you don't need to pay it off in 5 years. You can take a bit longer to pay off your home loan, but make sure you pay it off faster than the 20 years.
Yeah. Perhaps this, Warren. Is it a good idea to close a bond account or just keep it open? Various people say that you've got to actually pay money in to close the account. What do you know of this?
No, I mean, the trick there is, maybe don't let it go to zero. Let's say you had R1 million bond and it's, pay it down till the point where it gets to, let's say, 10,000 Rand that you owe. And then, you pay off the absolute minimum on that for time, and until the life of the bond is ended. So in most instances in our country, you can get a 20-year bond. So if you've paid it off in 10 years, then by all means keep it open for the remainder of the bond's lifetime, because having debts that you don't need and is really valuable. Most of the time, banks will give us a lot of debt when we don't need the debt and when we're in a great financial position. And I always think, if you can get access to the debt without actually having to use it, that's a great thing to do. Because, when life really goes wrong, the banks won't be lending you money then. They'll be demanding money from you. So having access to debt in those situations is great. And therefore, having a mortgage which is open, but you're not, using it to its capacity makes all the sense to me.
Right. Ticking all the boxes tonight. Things to do for 2022. We are now on the 6th of January. We are getting ready. What about your will? Should you get it current?
Absolutely. I think again, I'm referring to the pandemic a lot today, but I think the pandemic has taught us that death is literally kind of a sneeze away, and so you have to make sure that your will is sorted out. The only people who don't need a will are children under the age of 18 who are living at home and supported by their guardians. Everybody else needs a will. I don't care if you're single. You owe the world a lot of money and you have no assets, you need a will, because what your will does is it covers things like how do you want to be, do you want to be cremated? Do you want to be buried? Who needs to kind of deal with your estate? And if you don't have that stuff written down, you're relying on a division of government. You're relying on a government bureaucracy, which is not functioning well, to sort this stuff out for you. So actually what you're doing is leaving behind an enormous headache to your family. And it's even more critical if you've got children, because you need to write down in a legal document who's going to be responsible for your children if you're no longer around. And how you're going to financially care for them. So a will needs to be done and needs to be updated. I think at least once every 2 years, unless your life has changed dramatically, where you got married, got divorced, had children, had a death in the family. Anything that's affected your life, you need to check that your will's still current.
Yeah, very, 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 very important. All right, what about your RAs and your tax-free accounts? That's the other thing, and getting them ready before the end of Feb.
I think it's, we get so few kind of freebies from SARS that any kind of breaks that we get from SARS, we need to take advantage of. And so, to me, a retirement annuity or, company provident fund or pension fund are great vehicles to use to kind of build up your savings, but also to get as much of a tax break as possible. So make sure that you're contributing to your retirement funds and make sure you're maximizing that contribution. And then the other one is the tax-free savings account. Lots of people don't take advantage of tax-free savings accounts to their limit. And just as a reminder, that's 3,000 Rand a month or 36,000 Rand a year. And, if you haven't done that for this year and you've got the money available, make sure you do that 36,000 Rand before the end of February. And then try and select, investments that are biased in favor of growth assets. In other words, invest primarily in shares rather than in money market accounts or fixed deposits, because fixed deposits are really not going to grow your money ahead of inflation. So key there is, get growth assets, but certainly maximize the few legitimate kind of tax breaks we get from SARS, and that's the RAs and tax-free savings accounts.
It's interesting that you say that, because at the moment, your share, 75,000 points, the JSE has done really, really, really well. And if you are clever and you know what you're doing and you know which equities to bet on, you can actually make some money. And I say to bet on, but sometimes it's not just a bet.
No, it's not. I think you're absolutely right, Ray. I think it's, if you look at the JSE for the year 2021, it gave us a return, including dividends, of 29%. It grew faster than the world stock market, and that's measured in rands or in dollars. So 29% return is a fantastic growth rate. And so, over a 20-year period, you can expect the JSE to give you a return of around about 10 or 12% a year. And that's a phenomenal return, and that's not gambling, that's just buying, the all share index or, the top 40 or the top 50 index. And you don't need to be a rocket scientist or pick the best shares and, on the JSE and avoid all the losers. You can buy just the average, which is the index. And to get that kind of return, your money's doubling, every kind of 5 to 7 years. And that's where your wealth creation starts. And the only way you get that is you have to be invested. You have to be in there to get that growth.
And don't take it out. If the stock market does a bit of a topsy-turvy maneuver, don't take it out. Just wait and see what happens. A lot of people did that with COVID-19. When things started to crash a little bit because world markets were affected, they then took their money out. So they sold. And what a massive mistake.
Unbelievable. And it's amazing how humanity tends to repeat the mistakes over and over again in such a predictable fashion. So whenever markets kind of get a little bit volatile, a little bit rocky, we see this outflow of money and people start panicking and they sell out. They end up selling out, Ray, usually at the bottom of the market, unfortunately. Really right at, if it was trading at 100 and it loses 30%, it's suddenly trading at 70. That's where the bulk of people sell. And then if you ask them, when are you going to buy again? They'll say to you, I'll buy when things are better. Now let's just look at where we are in the world.
Yeah.
The world's not better now. The economy is not better, but the JSE is up 30% from, over a calendar year. That's an incredible return. And you only got that if you stayed invested. So I think you're so right, Ray. I can't emphasize that point more. Is that, just stay the course. You're not the genius that can predict when the market's going to crash, and you're not going to be able to predict when it's going to jump again. The reality, and the reason why I can say it with such confidence, is no one is able to do that over a long time. They can be lucky. It's a bit like flipping a coin and calling heads or tails. You can be lucky and call heads 3 times in a row. That doesn't mean you've got a special methodology. It just means you've been lucky. The next time it could easily be tails. And if you're adopting the same methodology with shares, you're relying on luck, which I think is crazy.
Yeah, it is crazy. You're quite right. Warren Ingram from Galileo Capital. Good to chat to you once again with our personal finance feature. Chat to you again soon.
Thanks so much.